right. Good morning, you magnificent melonhead. Today is Thursday, June 1st, the X date. And pandemonium, fire and brimstone, dogs and cats living together, right? Not so much. It's June 1st. Janet, Aunt Janet, Secretary Yellen, you told us everything would blow up if we didn't raise the debt ceiling by today. It's today. We didn't raise the debt ceiling. I don't hear any explosions. What's going on? Well, June 1st was always more of a suggestion, and it was never really a hard date. That was the estimate of when the government would run out of money. They came pretty close. The government still has about $37 billion, even though we're pretty much right there. Pretty much right there, about to get the debt ceiling deal done. The debt ceiling raise passed the House of Representatives yesterday. Interestingly enough, it passed the House of Representatives with more Democrat votes than Republican votes. That was kind of interesting. I wonder what that means for House Speaker Kevin McCarthy and his leadership on the GOP side in the House. But the big story was late yesterday. Nick Timiraos, who is the Fed's favorite mouthpiece over at the Wall Street Journal, when Jerome Powell or when any of the Fed governors, when they want to, I don't want to say leak, but when they want to nudge the market, Nick Timiraos is always the guy that they pick to do it. And Nick Timiraos came out with an article late yesterday that said the Fed was planning to pause in June, or I think the word was skip. They're going to skip the June rate hike, but that doesn't mean they're done hiking rates. They're calling it the pause, or they're calling it a skip. Call it whatever you want. No hike in June. Then they're going to wait to see some data, and then maybe they hike in July. That's kind of what they're suggesting, that the June rate hike has just been pushed out a month. Maybe they're going to go every other meeting from now on. Of course, the market liked that. The DXY went a little bit lower on that news. A less aggressive Fed means a weaker dollar. And then they added the caveat, though, that unless we see a sizzling jobs report. Well, this morning we got a sizzling jobs report. Whoops, that didn't age so well, did it? Now, this morning we got ADP private payrolls. This is not really the jobs number that you usually hear about in the press. ADP is the private sector number that usually comes in a few days before the non-farm payrolls report from the Bureau of Labor Statistics. Now, the non-farm payrolls report, that's the jobs number that everybody goes by. But ADP can give you a hint about what the non-farm payrolls number might be. They don't always correlate directly, but you can directionally, they're usually right. Well, ADP came out this morning, 278,000 jobs added last month in the economy. Way more than was expected. The economy was expecting, I believe, about 170,000, something like that. So it was a beat by 100,000 jobs. So is that a sizzling jobs report? You tell me. Does it sizzle? Does anybody hear a sizzle? I don't know if it's sizzling. Does it rise to the level of sizzle? I don't know. But it was more than expected. Now, the one caveat I would say within that jobs report, almost all of them were leisure and hospitality. Notoriously low-paying jobs. Of the 278,000 jobs that were added, according to ADP last month, 208,000 of those jobs were low-paying leisure and hospitality jobs. So if you take those out, we've really only got a net addition of about 70,000 quality jobs in the economy. Well, I mean, Texas can bust that many people into New York City in a week. So are the jobs growing? I think so. The economy does look to be adding jobs according to this data. And ADP, this is a private sector organization. This is based on payrolls data. These are not government statistics. That I want to drive home. But we also got some data yesterday. The JOLTS job openings came in a little bit higher than expected. Job quits were down a little bit. So also this morning, initial jobless claims, they were up versus last week, but up just barely, making a lower high. So it looks like the job situation might be stabilizing a little bit. We'll see Friday when non-farm payrolls comes out, but this is a little bit encouraging for the economy. And you guys know me, I don't really do optimism, so I just want to put that out there. Also, we got numbers from Macys this morning. They were predictably terrible. The situation in retail continues to deteriorate. The American consumer is up to his eyeballs in credit card debt, approaching $1 trillion nationally. It's not good things for retailers. And with that, we are going to shrink my big melon of a head And let's take a look at what's going on in markets. The S&P is down only 5.7 points, about 0.15% this morning at 4,172, still down below that 4,200 resistance level. That's important. We've hit that 3 times now this year, failed to break above it and stay there. The Dow is down. Whoa, big red candle down in the Dow this morning. Hello there. Down 200 points or 0.61% at 32,706. That one came out of left field. I don't know what's driving that big red candle. If you guys know, let me know down in the comments. Something must have just happened in the last few minutes. I was not expecting that one. NASDAQ faring better than the Dow, down 21 points or 0.16 at 12,913. Looking at the DXY, it is currently down 29 basis points. Again, the suggestion of a less aggressive Fed kind of fits with that narrative here that we're going to skip a rate hike, and so the DXY is pulling back. A more aggressive Fed usually means a stronger dollar versus other currencies. Well, interestingly enough, we were headed up this morning, and then at 8:15 a.m. Eastern time, that is exactly when that ADP payrolls number came out, it resumed its downward move. So does the ADP payroll report rise to the level of sizzle? According to the DXY, it does not, because that was enough to send the Dixie in the other direction, meaning the Fed probably will pause in June. And you can see that in the CME futures right now. This is interest rate futures. This is the predictability of the Fed rate hike. And right now, the market is saying 66.8% likelihood of no rate hike in June. Yesterday, these were reversed. There was about a 70% likelihood of one rate hike in June. Now it's about 66, 67% saying no rate hike in June. So the market right now is believing Nick Timiraos. Looking over at the bond market, we have got the 1 month. Just about everything is down in the bond market today, or all the yields are down, which is bonds slightly up, but it's only marginal. We're not looking at more than a couple of basis points either way. The 10-year yield is at 3.58, down 5 basis points. The 1 month at 5.2, essentially flat. So nothing happened in bonds this morning. Looking over at commodity, we've got gold is up a tick, up $7 at $19.89, still below 2,000. Silver at $23.70, up 11 cents. Silver's had a good couple of days. By the way, we had over 1 million ounces of silver leave the registered category yesterday and head back over to the eligible category. Silver is coming off the market. It's still in the COMEX vaults. We actually had a net addition to the COMEX vaults yesterday, but it's all in the eligible category, which means this stuff is not up for sale. So the available market for silver is declining rapidly. Currently, somewhere around 28 million ounces makes up the entire registered category. Inventory is getting lower in the silver market. Crude oil is up about 15 cents this morning at 68.25. We got that big OPEC Plus meeting coming up on June 4th when they announce everything. Interestingly enough, OPEC Plus, mainly driven by Saudi Arabia, yesterday they announced that American press will not be allowed in the meeting. Reuters, Bloomberg, Wall Street Journal, all of them were given the boot by the Saudis. They don't want American press at that meeting. It's interesting. Is this another middle finger from the Saudis to the Americans? Kind of looks like it, doesn't it? Elsewhere, we got natural gas is down 9 cents at $2.17. That's down 4% this morning. So market sees something it doesn't like in the natural gas data. But here is the story. This is the one that I think should be moving markets. It's not really having an effect. You'd think markets would be up on this news. Fed prepares to skip June rate hike, but hike later. Officials would slow increases to assess more data on the economy and bank lending. By the way, bank lending, what happened there? That last part there about bank lending, that may have something to do with why markets are down so much today. There was an article came out late yesterday that the CEO of Wells Fargo made some comments at some investment conference, the name escapes me, about losses in the banking sector driven by commercial real estate. Now, he was driving home that Wells Fargo isn't really going to be affected, that commercial real estate is a small percentage of Wells Fargo's loan book. But keep in mind, commercial real estate, the predominant exposure there for commercial real estate is U.S. regional banks. So they could have been telegraphing more trouble in the banking system ahead. Maybe that's why markets are down so much this morning. But back on the Fed, we have got Federal Reserve officials signaled they are increasingly likely to hold interest rates steady at their June meeting before preparing to raise them again later this summer. Investors in recent days had expected the Fed would lift rates at its meeting on June 13th and 14th, prompting two policymakers on Wednesday to publicly underscore their preference to forego a hike, barring a sizzling jobs report on Friday. There's that sizzling number. Will the jobs report sizzle? I don't know. But here we go. A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. This is according to Fed Governor Philip Jefferson, who I might add is Joe Biden's nominee to replace Lael Brainerd as the vice chair at the Federal Reserve. So he's saying, look, guys, we might pause in June, but don't get the idea that we're done hiking, because we could come in July and hike anyway. Indeed, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. So the Fed is telegraphing here, we're going to take the month off and we'll be right back to your regularly scheduled monetary tightening and rate hikes come July. But it wasn't just Jefferson who said that. We also had Philly Fed Governor Patrick Harker, who's a voting member of the FOMC this year. He also endorsed holding rates steady in June. He said, I think we can take a bit of a skip for a meeting. And frankly, if we're going to go into a period where we need to do more tightening, we can do that every other meeting. He said that Wednesday at a conference in Philadelphia. So you've got two Fed governors. You've got Philly Fed Harker and you've got Jefferson, Biden's nominee to be vice chair, both saying we are going to skip the June rate hike. And of course, now the market is saying probably no rate hike in June. Let's refresh this and see where we're at. The market is saying now a 71.5% likelihood that there is no rate hike in June. However, the July rate hike is still at 46.6%, saying one rate hike in July. Other news we got this morning. Here we go. United States ADP employment change. Is this a sizzling jobs report? You tell me. Private businesses in the U.S. created 278,000 jobs in May of 2023 compared to a downwardly revised 291,000 in April, and well above the forecast for 170,000 jobs. So a beat of 108,000 jobs. Here's the rub, though. The services sector added 168,000, led by leisure and hospitality with 208,000 jobs added. Almost all of these jobs added, they are low-wage leisure and hospitality jobs. These are not the kind of jobs that can support an American consumer who is $1 trillion in credit card debt. We need higher paying jobs in order to sustain those numbers. You'll see that in a moment in these Macys numbers. Things for the consumers are not looking good. Now, that was really the only big number. We had gains and losses in other sectors. We saw gains in transportation utilities, losses in financial activities, losses in education and health and information. On the manufacturing side, we saw job gains in mining, big job gains in mining, 94,000, 64,000 in construction, but manufacturing lost 48,000. So no real big moves one way or another. The big thing here was all of those leisure and hospitality jobs. And again, that's hardly a signal of strength in the economy. These are very low wage jobs. But we also saw a little bit of, I'll say, some signs of strength in the jobs market in the initial jobless claims data came out today. The number of Americans filing for unemployment benefits, it rose by 2,000 for the week, but it only rose to 232,000. And if just look at the trend here. Here is the trend going back to last summer, about last July. And you can see this is the trend of weekly initial jobless claims. And we hit that peak around March, right? The layoffs, they started in January, all the announcement of the tech layoffs. Then we had that carnage in the banks in March. It continued through May. But now here we are. You can kind of see the rate of initial jobless claims, people filing for unemployment benefits for the first time. It's starting to tick down. So maybe the surge in layoffs that we saw at the beginning of the year, maybe that's starting to taper off. At least that's what this chart is telling me. We're still bouncing up and down, but we're making lower highs here. So that's a little bit encouraging. And there's also some encouraging data here in U.S. job openings. This is the JOLTS report, came out yesterday. Job openings and labor transitions. The number of job vacancies in the United States unexpectedly increased by 358,000 to reach 10.1 million in April of 2023. That surpassed market expectations for 9.375 million. Now look, job openings, the JOLTS report. I've been very critical of this report in the past because this doesn't accurately reflect the trend of work from home and multiple postings for the same job. This also doesn't keep track of fake job postings. Joe Brown over at Heresy Financial did a fantastic video not too long ago about why the JOLTS report is basically, a lot of these are just fake job openings. So I don't take that 10.1 million number at face value, but I can look at the trend and the increase and say maybe there are some real jobs underpinning that increase. And you can see here job openings had been in rapid decline for the better part of a year, and now we've got an uptick here at 10.1. Now, something that throws a little bit of cold water on these encouraging jobs numbers is the jobs quits number. Also came out just yesterday. The number of job quits in the United States decreased by 49,000 from the previous month to 3.79 million in April of 2023. That is the lowest level since March of 2021. Now, why is that important? Do you guys remember the Great Resignation? Remember 4.5 million people a month were quitting their job. Everybody was leaving, work from home, all this stuff. Oh, I can get a job in New York even though I live in Cleveland. Well, that seems like the Great Resignation is breathing its dying breath right now, because look at the rate of job quits. This is people leaving their job, either going on unemployment or just going to work somewhere else. It is in rapid decline right now, the lowest since 2021. Well, if you're not so sure you're going to be able to find another job, you're probably less likely to quit your current job. And it looks like that's what's happening in this quits number. Now, we're still slightly above the pre-COVID level, right? Pre-COVID level, we would bounce around between 3.4 and 3.7 million. Right now, we're at about 3.8 million. So we're almost back to the number of people who are quitting their job every month before COVID. And that's why I'm saying the Great Resignation is breathing its dying breath. Now, if the jobs market was really that tight, if it was so easy to find another job, if there really were tens of millions of openings, then you would still see this number higher. People would still be trading up for a higher wage, although that's starting to taper off. So these days, since the work from home trend has started, it's been very difficult to draw conclusions from the jobs data because it's a mess. The data collection, the analysis has not evolved with the jobs market since COVID hit. So we've got indicators now of strength in the jobs market, but this is an indicator of weakness in the jobs market. You guys make up your own mind. Let me know down in the comments. Do you think the jobs market is strong or isn't it strong? And last but not least, Macys. This is another one. Macys. Companies that shouldn't exist anymore for 1,000, Alex. Macys falls after cutting outlook as demand trends worsen. The company points to economic factors weighing on purchases, and sales at Macys, Bloomingdale's fell while Blue Mercury rose. Blue Mercury is their cosmetics brand. I had to look that one up. Sorry, I don't know who the makeup companies are, guys. Macys Inc. said earnings will be weaker than previously expected for the full year, underscoring the uncertainty around U.S. consumer spending through the remainder of 2023. Now, here's what we got here. There we go. Same-store sales. Anytime you're talking about a retailer, guys, you skip the noise and you go to same-store sales. That's how you tell how the retailers are doing. Same-store sales at Macys' namesake brand sank 8.7% on an owned basis, while the higher-end Bloomingdale's dropped 3.9%. Blue Mercury, the one silver lining here, rose 4.3%, but I would add that Blue Mercury, 4.3%, that's still below the rate of inflation. So we're still looking at lower sales, less stuff walking out the door. And that was the higher end of Macys numbers. The other ones are down big. I mean, an 8.7% decline in same-store sales amid 5-6% inflation. Guys, that is just terrible. This company is doomed. This is a mall stock. We saw something similar in Foot Locker. The mall stocks are dead, guys. And again, anytime you're talking about a retailer, skip everything else. Go right to those same-store sales numbers. And Carl Quintanilla over at CNBC, he had a couple of good quotes from their conference call this morning. The Macys CEO said that as April progressed, demand worsened across nameplates. So he's saying across all of their stores, as April went on, things got worse and worse. That means the decline in the American consumer is continuing. Inflation continues to take a bite out of people's bottom lines. And the Macys CEO said cooler temperatures and headlines surrounding layoffs, as well as the banking crisis, were factors that impacted demand trends. Go figure, headlines about banks failing makes people less likely to want to go out and spend money. Apparently more people are paying attention than we realized, and Macys stock right now currently feeling the pain, down only about 2.7%. Things could be a lot worse for Macys. They were down as much as 15% after hours last night. So I'd say Macys, all things considering, they're probably doing better than they should do. And just so we're clear on the daily Treasury statement, looks like it's bill's going to the Senate. It's probably going to get passed, and then Joe Biden's going to sign it right away. We probably got another 24 to 48 hours before they're done. Well, they've got $37.3 billion to play with while the government, that's the money they've got, $37.3 billion. All right. Take it or leave it, folks. That's got to last until this deal gets signed and stamped by President Biden. All right, guys, that's all I got for you today. Just a reminder, we are doing our Patreon Zoom call today on Thursday because of the long weekend threw off my schedule. So we will be getting together at 3 p.m. Eastern time today. Looking forward to talking to you Patreon guys. There's a link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.